In the world of finance, informed decision-making is vital for success. For millennials, navigating the financial landscape has been a unique journey filled with challenges and opportunities. One such opportunity that has captured the attention of this generation is Bitcoin, a digital currency that holds the promise of financial autonomy and wealth accumulation. However, with great potential comes great responsibility, and understanding the risks associated with Bitcoin is of utmost importance. Welcome to Luxo-Life, your partner toward personal growth and success. In this third episode of our series, Bitcoin for Millennials, we'll reveal the most common potential risks in cryptocurrency investing and equip you with the knowledge and strategies to help you make well-informed decisions and keep your money safe. Let's get started. Number 1. Volatility. In every investment market, there's always a risk of volatility. Prices and values fluctuate over time and are directly or indirectly affected by economic influences. The same is true for Bitcoin. Cryptocurrency is notorious for being a highly volatile market, not just because of their staggering price increase and decrease in a short amount of time, but also because they're directly affected by consumer trends. When an investor decides to pull or sell out his money from Bitcoin for some random reason, this can immediately affect the value of Bitcoin, especially when said investor owns a couple of coins worth $34,000 each. If other investors see that Bitcoin's value drops because of this sudden occasion, they too would consider selling out their coins. This often happens with new investors who had already spent thousands of dollars in Bitcoin only to see a drop in value in the next hour or so. While Bitcoin is directly unaffected by certain economic influences such as dollar printing, inflation, recession, and bail-ins, it can still be affected indirectly due to market sentiment. When people are going through tough financial crises, they either want to save or use money to make ends meet. Usually, a person's first reaction to an economic downturn is to pull out money from volatile investments such as Bitcoin. In the case of a person selling his coins to get his money back and weather the financial storms, Bitcoin is affected by economic influences. One notable instance when Bitcoin experienced a significant drop in value due to a mass consumer pullout or a large-scale sell-off occurred in December 2017. During that time, Bitcoin's price was on a meteoric rise, reaching an all-time high of nearly $20,000 per Bitcoin. The rally was driven by a massive wave of interest from retail investors, speculators, and institutional players, all looking to capitalize on the cryptocurrency's rapid appreciation. However, as Bitcoin's price approached the $20,000 mark, many investors and speculators decided to cash in on their profits, resulting in a substantial sell-off. This sell-off was particularly notable because it happened within a relatively short time frame, causing Bitcoin's price to experience a sharp and rapid decline. This price correction was a result of a mass consumer pullout, as many participants in the market decided to take their gains and exit their positions. The reasons for this mass consumer pullout were multifaceted. Some investors may have wanted to lock in their profits after witnessing such substantial price gains. Others may have been concerned about the sustainability of Bitcoin's price levels and the potential for a price bubble. Additionally, there were increasing concerns about regulatory scrutiny, security issues, and the scalability of the Bitcoin network, which contributed to investor uncertainty. As a result, Bitcoin's price plummeted from its all-time high in December 2017 to around $6,000 in early February 2018. This price adjustment acted as a wake-up call to the speculative and volatile character of the cryptocurrency market. It highlighted the impact of a large-scale investor actions on Bitcoin's value and reinforced the importance of understanding the risks and market dynamics when investing in cryptocurrencies. Since then, Bitcoin has experienced various price cycles with periods of both rapid appreciation and price corrections, showcasing the ongoing influence of the market sentiment and investor behavior on its value. So how can you overcome or mitigate Bitcoin's natural volatility? The answer, of course, is proper risk mitigation. In the next video of our series, we're going to give you more tips and advice on investing in Bitcoin, mitigating the risks, and reaping the benefits. But for now, we'll satisfy you with a little taste of what's next. First, always diversify your investments. Bitcoin is a good investment, but it's only one of the many good ones. By holding a mix of assets, including more stable ones like bonds and traditional stocks, you can reduce exposure to the price fluctuations of any single asset. Second, assess your risk tolerance and invest accordingly. If you can't stomach losing 50% or even 90% of your investment, don't invest in high volatility markets. Aim for a more conservative approach, but if high risk and volatility are your bread and butter, then you can invest in high-risk, high-reward markets that align with your financial objectives. Third, aim for the long term. Worrying over sudden fluctuations and pulling out immediately is a newbie investor's mistake. If you have long-term goals and perspectives, you can worry less about the now and think more about the future. Those who have held onto their investments for years have often realized substantial gains. By focusing on the potential of Bitcoin over the long haul, millennials can approach their investments with greater patience and resilience. For millennials looking to invest in Bitcoin, it's essential to strike a balance between risk and reward. This begins with recognizing that the path to wealth accumulation may not be a straight line. The potential for substantial gains is offset by the possibility of losses. A prudent approach is to only invest what you can afford to lose. This way you can remain resilient through the price turbulence, taking both the highs and lows in stride. Number 2. Scams. Remember that Bitcoin is a digital currency, and like everything else on the internet, scammers and hackers can break in. Thanks to blockchain technology, Bitcoin has a higher than average form of digital security, but failure to stay vigilant with your digital assets can cause devastating losses. So let's look over the common cryptocurrency scams that you need to watch out for. Ponzi schemes. Be highly cautious of any investment scheme that promises unrealistically high returns with minimal risk. These are often classic Ponzi schemes where early investors are paid with the capital of newer investors. Ponzi schemes are designed to defraud investors and ultimately collapse when there aren't enough new investors to pay returns. Be skeptical of any investment opportunity that seems too good to be true. Fake ICOs or initial coin offerings were a popular fundraising method in the cryptocurrency space. However, their popularity has also made them a cover for fraudulent activities. Scammers create fake ICOs, promote them aggressively, and encourage people to invest. Verify the legitimacy of any ICO before investing. Research the project and the team behind it, and look for reviews and feedback from reputable sources. Be cautious about investing in any ICO that lacks transparency or a clear use case. Social engineering. Social engineering techniques are frequently used by scammers to trick people into sending Bitcoin, disclosing private keys, or divulging sensitive information. They may impersonate customer support representatives, friends, or trusted figures in the cryptocurrency community. Any communication that seems out of the ordinary, including unsolicited messages or demands for personal information, should make you cautious and wary. Verify the identity of the person or entity you're interacting with, and avoid sharing sensitive information or making hasty decisions. Phishing. In the world of cryptocurrency, phishing efforts are frequent. Fraudsters can create fake websites or send emails that impersonate legitimate cryptocurrency services. The goal of these misleading emails is to fool you into disclosing your private keys or other confidential information. Always confirm that emails and web pages are real. Be cautious when clicking on links or downloading files, and never share your private keys or seed phrases with anyone. One of the best ways to protect yourself from security scams is to know who you're dealing with, what they're dealing with, and how they're dealing. You can also use hardware wallets to store your digital assets and enable two-factor authentication on your exchange account and wallet services. Number 3. Regulatory and legal considerations. While Bitcoin offers financial autonomy, it is not immune to legal and regulatory implications. Understanding the legal considerations can help millennials make informed decisions and avoid getting into trouble with the IRS or the local taxation bureau. Bitcoin taxation practices vary widely across different regions. In some countries, Bitcoin is treated as a commodity, while in others, it's categorized as a currency. Millennials must be cognizant of their tax responsibilities and adhere to local regulations when it comes to reporting their cryptocurrency holdings. Stay informed about the tax implications of Bitcoin in your area is essential for legal compliance and financial planning. Now that we've gone over the most common risks that come with Bitcoin and cryptocurrency investing, here are some additional tips to navigate the risks associated with Bitcoin effectively. Millennials should implement risk management strategies that align with their financial goals and risk tolerance. First, self-educate. Knowledge is your best defense against risk. Continuously educate yourself about Bitcoin, the cryptocurrency market, and evolving investment strategies. One way to do that is by following our current series and watching our other related videos. Second, start small. Consider starting with a small investment to get a feel for the market's dynamics and to gauge your risk tolerance. As you become more comfortable, you can incrementally increase your holdings. Third, stay informed. Regularly follow cryptocurrency news, monitor your investments, and adapt your strategy as necessary. Being proactive in your approach can help you respond to changing market conditions effectively. Bitcoin presents millennials with a promising avenue for financial autonomy and wealth accumulation, but it is not without risks. Understanding and managing these risks is a crucial aspect of responsible Bitcoin investing. With the right knowledge, security measures, and risk management strategies in place, you can harness the potential of Bitcoin while minimizing the potential pitfalls. By approaching Bitcoin investments with a well-informed and prudent mindset, millennials can navigate the world of cryptocurrency with confidence and make decisions that align with their financial goals and aspirations. If you liked this video, leave us a like and subscribe to the channel if you haven't yet. Also, if you haven't watched the first 2 videos on this series, you can check them out here. As always, thanks for watching, and we'll see you again next time.